Okay, so let's just unpack this. Imagine you're standing in a room, right? And it's filled with the absolute wealthiest, most powerful people on earth.
Oh, wow, okay.
Yeah, it's July 1999, the ultra-exclusive Allen and Company conference out in Sun Valley, Idaho.
Right at the absolute peak of the dot-com bubble.
Exactly. Like the bubble is inflating at warp speed, creating billionaires overnight. And you are standing at the podium looking out at the sea of tech moguls.
Which is terrifying in itself.
Totally.
Yeah.
And you have to tell them that they are, well, completely delusional, that their wealth is an illusion, and that a devastating crash is inevitable.
Oh, man.
Yeah, that is the exact situation Warren Buffett walked into. And what's wild is that the audience was already laughing at him behind his back.
Right. They were calling him a has-been, saying he was too old to understand the internet.
Welcome to today's deep dive, by the way. We're digging into The Snowball, Warren Buffett and the Business of Life by Alice Schroeder.
It's such a massive, fascinating book.
It really is. But our mission today isn't just to, recount a biography. We're doing this deep dive specifically for you, the listener, to bypass all the information overload.
Right. To extract the foundational mental models, the actual psychological wiring that allowed a kid from Omaha to snowball a few nickels into a multi-billion-dollar empire.
Exactly. And that Sun Valley story, it's just the perfect place to start.
It really is, because it represents the ultimate stress test of his entire philosophy. I mean, you have these tech CEOs strutting around the resort in polo shirts, throwing around buzzwords like new paradigm.
Monetizing eyeballs.
Exactly, monetizing eyeballs. And then there's Buffett. He flies in on a massive NetJets Gulfstream fee, which is a company he literally owns.
But he steps off the plane carrying his own luggage.
Yes. Carrying his own bags. And he's just drinking his cherry Coke, completely buried in his financial newspapers.
He's entirely unfazed by the fact that he is, the least popular guy at the resort.
Right. But then comes that keynote speech, the closing event of the conference.
Okay, set the scene for us. What does he actually say?
Well, he uses historical data to just totally dismantle their entire worldview. He points out that at the start of the 20th century, there were roughly 2,000 auto companies in the U.S.
2,000?
Yeah, and about 200 airline companies. And he tells them, look, both of these inventions fundamentally changed the world.
Right. The innovation was real. No one's denying the car changed everything.
Exactly. But they absolutely ruined the people who invested in them. Out of those 2,000 car companies, only 3 survived.
Oh.
And for a time, they were selling for less than book value.
We should probably clarify what book value means there.
Yeah.
Because it's a super crucial concept to his argument.
Good call. So selling for less than book value means the market capitalization of the company, the total price of all its stock, fell so low that it's actually less than the physical scrap value of their factories.
Like the real estate and the inventory.
Right. You could literally buy the company, shut it down, sell the machines for scrap metal, and make a profit.
That is insane. That's how violently the market corrected after the initial automotive hype.
Exactly. So he's essentially telling these internet billionaires, hey, innovation does not equal investment return.
Just because the internet will change the world doesn't mean your specific .com stock isn't going straight to zero.
Right. And he even told this incredibly pointed joke about an oil prospector to really drive it home.
Oh, the heaven and hell joke. I love this one.
It's so good. So the prospector dies and goes to heaven.
Yeah.
But St. Peter tells him the pen for oil prospectors is at full capacity.
So what does the guy do?
He yells out, oil discovered in hell.
Yeah.
Instantly, all the other prospectors stampede out of heaven and run down to hell.
Right.
St. Peter is impressed and says, great trick, you can have your spot in the pen now. But the prospector pauses and says, no, I think I'll go with the rest of the boys. There might be some truth to that rumor after all.
It's a perfect metaphor. It was a surgical strike against their collective greed.
He was mocking the way they bought into their own ridiculous hype.
And to twist the knife, his gift to the billionaires at the end of the conference was a jeweler's loupe.
Yes. So they could inspect the diamonds on their third wives' rings. It was incredibly bold.
So bold. But the core financial lesson he was delivering there was the distinction between the market as a voting machine versus a weighing machine.
Right. In the short term, the market is basically just a popularity contest. It's a voting machine driven by hype, crowd psychology, and FOMO.
But in the long term, it is a weighing machine. It ultimately has to weigh the actual tangible cash that a business produces.
You can't run on hype forever. Eventually, you have to show the profit. And the fundamental force pulling on that scale-like, the financial gravity, is interest rates.
Right. Buffett explained that when interest rates are extremely low, asset prices just kind of float upward.
It creates this illusion of infinite growth. It suspends the normal rules of economic gravity.
So he was essentially using interest rates as the sobering reality check against their euphoria. They thought they had a new paradigm, but they were just experiencing low financial gravity.
Exactly.
Yeah.
But putting yourself in that room, the pressure to conform would have been immense.
Oh, totally. I mean, thinking you can pick the one winning internet stock in 1999 is a lot like thinking you should have shorted horses in 1900.
That's a great way to put it.
It sounds totally obvious in hindsight, right? But making that bet in the moment, when the entire world is moving in the opposite direction, is practically impossible.
Which is why the audience sat there in stony silence.
Mm-hmm.
They did not want to hear that their wealth was just the product of a voting machine gone haywire.
But if you're listening to this is where we really have to peel back the layers of the biography, because the real mystery isn't the financial math of 1999.
Right, it's the psychology.
Exactly. Where does a person get the psychological armor to stand in a room full of the wealthiest people on earth, tell them to their faces they are greedy and wrong, and truly not care that they are laughing at him?
It's incredible. And to understand that level of mental independence, we have to travel back to his childhood in Omaha.
Right, to look at a concept Buffett calls the inner scorecard.
The inner scorecard is perhaps the single most vital mental model Buffett possesses. And he defines it with this provocative thought experiment.
Oh yeah, the lover experiment. Lay it out for us.
Okay, so he asks, would you rather be the world's greatest lover, but have everyone in the world think you're the worst? Or would you rather be the world's worst lover, but have everyone think you're the greatest?
Man, that strips away all the vanity instantly.
It really does. If you choose the first option, you are operating on an inner scorecard. Your satisfaction comes strictly from your actual reality and your own principles.
But if you choose the second, you're driven by the outer scorecard. You crave external validation above the actual truth.
Exactly. And Buffett received a very extreme, polarizing masterclass in both these scorecards from his parents.
His father, Howard, right.
Right. Howard was a 100% inner scorecard man.
And we need to adhere to a strict neutrality rule here when discussing Howard, because, he was a politician.
Right. A very vocal one.
So just to be completely clear to everyone listening, we are absolutely not taking a political side here. Whether you align with his views or vehemently oppose them isn't the point.
Right. We're strictly looking at the underlying psychology of the man.
Exactly. So, impartially speaking, Howard was a fiercely principled, deeply conservative politician. He despised FDR's New Deal.
He even voted for the Taft-Hartley Act, which restricted labor unions.
Knowing full well it was directly against the wishes of his own union constituents in Omaha who elected him.
Yeah, he just did not care about optics. He predicted runaway inflation to the point where he literally hoarded a massive sack of sugar in their attic just to be prepared.
The defining trait of Howard Buffett was that he was unshakable. He operated entirely on his own set of internal convictions.
Regardless of the massive public fallout. But the dynamic in the household was incredibly fraught because Warren's mother, Layla, was the exact opposite.
She was completely consumed by the outer scorecard, like what the neighbors thought was the absolute most paramount thing in her universe.
To the outside world, she maintained this illusion of the peppy, sweet, perfectly put-together mother.
But behind closed doors, the reality was just terrifying. She was deeply volatile.
She would subject Warren and his sister Doris to these devastating, hours-long verbal rages.
He'd basically back them into a corner, right?
Yeah.
And berate them over every real or imagined flaw until they were reduced to tears.
It was brutal.
Yeah.
And the scariest part for a child was that it was entirely unpredictable.
Right, and this is the absolute crux of his psychological development. Experiencing that kind of emotional volatility forces a child to adapt.
Right, when the person who is supposed to be your primary source of safety becomes a source of unpredictable terror, you have to survive that somehow.
So if the outside world, specifically the emotional world of his mother, was that chaotic, he had to find a completely different reality to live in.
Exactly. And where does a kid go to find a sanctuary from that kind of psychological warfare?
He goes to numbers, because numbers don't yell.
They don't change their minds, they don't throw tantrums, and they don't manipulate you based on their mood.
2 + 2 is always 4. Mathematics provided young Warren with absolute, predictable control over his environment.
It makes perfect sense. And you see this obsession with calculating and categorizing start. incredibly early.
Yeah, he didn't just play with toys, he analyzed them, like the bathtub steeplechase.
Oh, that's such a great story.
Right, he would line up his glass marbles on the edge of the bathtub, fill the tub with water, and race them down the porcelain slope.
But he wasn't just watching them splash around. He was timing them meticulously with a stopwatch.
He was establishing a statistical baseline. By timing them over and over, he was learning how the physical traits of the marbles affected their performance.
He was literally teaching himself how to handicap probabilities as a kid.
And he scales that up to the real world almost immediately, like he'd go around to local gas stations in Omaha and sweep up thousands of discarded bottle caps.
Just from the vending machines. And again, he wasn't just hoarding them like a normal kid collection.
No, he dragged them down to his basement and systematically sorted them. Coke, Pepsi, root beer.
By counting the discarded caps, he was creating a data-driven map of which sodas actually had the highest market share in his neighborhood.
It was pure empirical market research. The physical world was just a puzzle of odds and data to him.
But that analytical mind truly locked into its lifelong trajectory when he was 10 years old, when his father took him on a trip to Wall Street.
Oh, the Sidney Weinberg meeting at Goldman Sachs, which is a great networking story on its own.
It is. But the actual revelation for Warren wasn't the powerful executives. It was a man he spotted on the floor of the New York Stock Exchange.
Right. A guy whose only job, his entire profession, was to sit there and roll custom cigars for the brokers.
Just sitting there rolling cigars. And Warren reverse engineers the economics of that immediately.
He looks at that cigar roller and deduces, wait, if these brokers have so much excess capital that they can pay a full-time salary to a guy just to hand roll their tobacco,
then the stock market isn't just a place where people work. It's an absolute river of endless cash.
that is the exact moment his ambition crystallizes. And shortly after, he goes to the local library and finds a book called 1,000 Ways to Make $1,000.
Right. It features a chapter on penny weighing machines. You buy a scale, put it in a store, and it weighs people for a penny. The machine does the work.
But more importantly, the book introduces him to the mathematical magic of compounding interest.
Now, if you're listening to this, you probably heard a million times about the magic of compounding, right? That earning interest on your interest creates an exponential curve.
Oh, constantly. But looking at a 10-year-old Buffett, you realize compounding isn't just a math trick. For him, it was a profound psychological discipline.
He realized that $1 today and $10 in the future were exactly the same thing. They were just connected by time and a steady rate of return.
So spending $1 today wasn't just spending $1, it was destroying $10 in the future.
It changes how you view every transaction. You start seeing the opportunity cost of every single penny.
And he was absolutely ruthless about it. Remember the juicy fruit story?
Oh man, at 6 years old.
Yes. 6 years old. He's buying multi-packs of juicy fruit gum to sell door to door in his neighborhood. And a neighbor, Mrs. McCoubry, asked to buy just one single stick of gum.
And 6-year-old Warren looks this grown woman in the eye and flat out refuses to break the 5-stick pack.
He would not compromise his profit margin, and more importantly, he understood inventory risk.
Right. If he broke the pack, he was stuck holding 4 sticks of gum he might not be able to sell.
At 6 years old, he prioritized the structural integrity of his business over social politeness.
It's a stark example of the inner scorecard overriding the outer scorecard. He didn't care she thought he was a stubborn kid. The math was the math.
But of course, theory and small-time gum sales are one thing. Putting real capital on the line in the actual stock market is another.
Oh yeah. And his first real investment resulted in the most formative mistake of his life.
Let's look at the mechanics of this first trade because it's a perfect encapsulation of everything we've talked about so far.
Okay, so he's 11 years old. He pools his hard-earned money from his various side hustles with his older sister, Doris.
And they take that capital and buy 3 shares of City Service Preferred stock at $38.25 a share.
Right. It was a classic value play that he found through his father's brokerage.
And by value play, we mean he believed the stock was priced lower than the inherent underlying worth of the company.
He bought it below its true value. But shortly after they buy it, the broader market drops, and the stock falls from 38 down to 27.
Which introduces the ultimate variable human emotion.
Yeah. Doris, who was already the frequent target of their mother's terrifying rages, directs all of her mounting anxieties squarely at Warren.
She complains to him about the falling stock price every single day on their walk to school. She is badgering him, projecting her fear of loss onto him.
And the emotional pressure becomes suffocating for a kid who uses math to escape emotional pressure.
Her outer scorecard panic completely invades his inner scorecard logic.
It really does.
Yeah.
So the second the stock finally recovers and hits $40, Warren caves to the emotional pressure.
He sells it all. He secures a tiny $5 total profit, mostly just to make his sister's nagging stop.
And in a brutal lesson of market timing, shortly after he sells to relieve that psychological anxiety, the stock skyrockets to $202 a share.
Oh, ouch. That is agonizing.
It's painful just to think about.
It's like buying a highly profitable, deeply discounted local bakery, but then selling it 2 weeks later for a fraction of what it's worth, just because the cashier you hired won't stop complaining about the color of the walls.
Right. You let an external emotional irritant override your internal mathematical logic, and you miss out on the massive payday.
Exactly. But because he had the analytical mind to dissect his own failure, he extracted 3 fundamental lessons from that agonizing missed opportunity.
First, he learned never to fixate on the price you paid for an asset. The market doesn't care what your entry point was.
The stock doesn't know you own it.
Exactly. And the second lesson naturally follows. You can't rush to grab a tiny profit just to relieve short-term psychological anxiety.
Right. If the underlying math of the business hasn't changed, you have to let the compounding do its work. You have to ignore the daily voting machine.
Precisely. And the third lesson was deeply personal. He realized he had to be extremely careful when taking responsibility for other people's money.
Because Doris's emotional panic infected his rational strategy.
Right. He learned that if you manage capital for people who don't share your inner scorecard, they will force you into terrible decisions at the exact wrong time.
It's a foundational set of rules, but right as he's mastering his financial discipline, his personal world gets totally uprooted.
Yeah, his father gets elected to Congress, and the family has to move from Omaha to Washington, D.C.
And Warren absolutely hates it. He loses his geographic sanctuary, he feels socially awkward, he starts failing his classes, and he essentially turns to juvenile delinquency.
It was a very stark rebellion. He felt totally disconnected from his safe, predictable world, so he channeled all of his frustration into acting out.
He even ran away from home at one point, ending up in Hershey, Pennsylvania.
Yeah. And he wasn't just a mild troublemaker. He and his friends were actively shoplifting from the local Sears store.
They stole hundreds of golf balls, just hoarding them in his closet. But what's fascinating here isn't just the rebellion itself, it's how he applied his ruthless capitalist principles to his teenage delinquency.
He didn't just throw a standard paper route to make pocket change, he aggressively expanded.
Right, he threw 500,000 newspapers on the Westchester route, which delivered to U.S. senators.
And he mastered the physical mechanics of tossing the heavy papers so they landed exactly inches from their doors. He was maximizing efficiency.
And he took that same logistical mindset into the local barbershops, creating a pinball machine empire with his friend Don Danley.
The mechanics of that pinball business are incredible.
They are. They weren't buying shiny new machines. They bought a broken, used machine for $25, which is a depreciating asset.
And they approached a local barber and pitched a revenue-sharing model.
Right. The barber provides the floor space-free real estate, and Warren provides the machine. They split the profits 50-50.
It perfectly aligned their incentives. And what did Warren do with his cut of the nickels? He didn't spend it.
He reinvested the cash flow immediately to buy a second machine, and then a third.
It was compounding in action, playing out the back of barbershops. He was building a conglomerate model before he even had a driver's license.
But perhaps the most important education he received during his teenage years wasn't in D.C. at all. It was back in Omaha during the summers, down at the Axar Ben horse racing track.
Oh, the practice of stooping.
Yes, he and his friends would crawl around the grimy floorboards of the grandstands, meticulously scanning the ground for discarded betting tickets.
They were looking for winning tickets that novice gamblers had thrown away by mistake, usually because they didn't understand the complex payout rules.
That was the hustle, right? But the real education came from studying the daily racing form.
Yeah, he was learning the mechanics of pari-mutuel betting. In pari-mutuel betting, the track odds aren't set by the statistical probability of the horse winning.
Wait, they aren't?
No, they are set by the crowd, the total pool of money bet on each horse.
Ah, so he's looking at the crowd's sentiment versus the horse's actual biological speed. He's looking for the mismatch between the voting machine of the bettors and the weighing machine of the horse's actual capability.
Exactly.
So what did studying that mismatch teach him about the psychology of losing? Because gamblers notoriously chase their losses.
It taught him two profound rules of the racetrack. Rule number one, nobody ever goes home after the first race.
The entire system is psychologically designed to keep you playing, to keep you feeding the machine until you lose.
Right. And rule number two, you don't have to make it back the way you lost it.
That is so good. So if you lose on a bad bet in the third race, you shouldn't double down out of spite or panic on a mediocre horse in the fourth race just to get back to even.
Exactly. The track doesn't know you lost money, and it owes you nothing.
Man. And if you look closely at that racetrack strategy, it's the exact same logic he later applied to Wall Street.
You never make an emotional trade just to instantly recoup a loss. You simply wait for the next rational opportunity, the next mathematical advantage, even if you have to sit on your hands for years.
So by his late teens, he has the mathematical architecture completely built. He understands compounding, intrinsic value, odds, and emotional discipline.
But there's a glaring hole in his armor. He is still a socially isolated young man who is absolutely terrified of girls.
Right. He realizes his smart aleck, abrasive, contrarian attitude is a massive liability. He wants people to like him. He wants to be able to influence people.
But how does a guy who views the entire universe through the cold, hard lens of numbers approach something as messy as human empathy?
He approaches it the only way his mind allows, as a statistical math problem.
And we have to ask why. Why use an algorithm for human connection?
Well, remember his childhood?
Exactly. His mother's emotions were a weapon. Unpredictable human emotion was the most dangerous thing in his world.
So if he could turn human interaction into a predictable, controllable formula, he could remove the danger.
That is profound. It explains why he gravitated so heavily toward Dale Carnegie's famous book, How to Win Friends and Influence People.
Right. He didn't just read it as self-help advice. He treated it like a rigorous scientific experiment. He actively tracked the social data in his head.
He would say to himself, okay, if I criticize someone today, what is the data point? A negative reaction, resistance, a damaged relationship.
But if I offer sincere appreciation, what is the result? A positive reaction, compliance, a stronger bond.
He tallied the reactions up like he was sorting those bottle caps in his basement. He systematically hacked his own emotional intelligence.
The data proved to him that Carnegie's rules worked with mathematical certainty.
He realized that while financial capital compounds through interest, social capital relationships and human influence compounds through sincere appreciation and the strict avoidance of criticism.
It sounds almost mechanical to treat empathy like a horse race handicap, but the genius of it is that it completely removed his ego from the equation.
Yeah, his mother's rages were entirely ego-driven, entirely about her outer scorecard.
By focusing systematically on making other people feel valued, he protected his own inner scorecard while smoothly navigating the social world.
He turned his natural abrasive contrarianism into charismatic, highly effective statesmanship. It was the final piece of the fortress.
He could now manage businesses, manage people, and manage his own psychology, which brings this entire deep dive full circle.
Back to Sun Valley.
Right. We started by asking how Buffett could stand in front of the world's most powerful tech billionaires at Sun Valley in 1999, tell them their internet paradigm was a financially gravity-defying illusion, and not care when they laughed at him.
And the answer lies in the architecture of a mind built over decades of calculated survival.
Exactly. The little boy who found safety from his mother's volatile rages by counting bottle caps and racing marbles had built an absolutely unbreakable inner scorecard.
He didn't care what the tech billionaires thought of his speech, just like his father Howard didn't care what the voters thought when he hoarded sugar.
Warren utilized the brutal lesson of patience he learned from his sister Doris in the city's service stock.
He applied the cold, hard probability math he learned from stooping at the Axar Ben racetrack.
He knew the tech bubble was just a racetrack where everyone was betting on the hype, refusing to go home after the first race.
And he delivered that devastating message at Sun Valley using the interpersonal charm and folksy humor he statistically hacked from Dale Carnegie.
His mental fortress wasn't just built on a talent for math. It was fortified by his absolute refusal to let the crowd dictate his reality. He knew he didn't have to play their game to win.
Which is such a powerful lesson.
It really is. Which leaves us with something really profound to chew on. If you are listening to this right now, the ultimate takeaway from Warren Buffett's life isn't a formula for picking stocks.
No, it's about the blueprint of your own mind.
So take a hard look at your own life and ask yourself, in your career, in your relationships, or in your investments, Are you operating on an inner scorecard, doing what you rationally know is right, even when it's unpopular?
Or are you secretly playing to an outer scorecard, terrified of what the neighbors or the internet or the market might think of you?
Because if you truly want to build an invincible mental fortress, you have to decide once and for all who is keeping the score.